Hello and welcome back. We're going to talk about a long-term liability, bonds payable. When a company wants to borrow a large sum of money, they can either issue bonds or stocks. The difference is bonds are a liability, they are borrowing money, and they need to repay the money at some point of time. And on any liability, any borrowings, you're going to have to pay interest. And that's what we're going to look at in this video. So let's look at the example where a company has borrowed money and they have gotten more money than they expected when they borrowed the money. So we have Oreo company that has issued a $600,000 10-year 6% bond at 103. So let's do the journal entry for this and understand what we have over here. I'm the company, I wanted to borrow $600,000. So I asked the public to loan me $600,000. I tell them I'll repay the money at the end of 10 years. Over the next 10 years, I'm going to pay them 6% interest on the $600,000. When I sold the bonds, I actually got more than I asked for. And that's the last question. Why did it sell at more than face value? And we'll answer that in a minute. Let's first do the journal entry. So in our journal entry, on January 1st, 2022, that's the first requirement, I have sold the bonds, I have borrowed money. I'm the company that's borrowing the money, incurring the liability. The person who is giving me the money, it's an asset for them, it's an investment for them. In my books, it's a liability. How much did I borrow? I borrowed $600,000. I got 103, which means I got 103% of the face value. So the amount I got was 600,000 times 1.03, which is $618,000. This extra $18,000 that I got is bond premium. So the question asked over here, explain why the bonds sold at a price above the face value. It's most likely because my bonds were in demand. It's a simple question of demand, supply and demand, as you learn in economics. So if my bonds are desirable, there's going to be a great demand for it, and then I can sell it at a higher price, which is what we're looking at. So why would there be a demand for my bonds? In most cases, it's one of two reasons, or really a combination of two reasons. One is I'm a good company in that I have a good financial standing, so people are confident loaning me the money. And the second thing is, everything else equal, I'm probably offering an interest rate that is way better than what anyone else is offering in the market. So if you could get 5% in the market for a similar investment, and I'm offering you 6%, you obviously want to come and invest with me, which is why you're willing to pay me a premium. So in my books, when you see the word bond premium, when you see the word bond premium in the books of a company, it means they sold it for more, it's a gain. So why not just call it a gain? If I called it a gain, it would go into the income statement in the current year. And the matching principle, as you know, says that if you're going to get the benefits from the bonds over the next 10 years, you need to spread that amount over the next 10 years, which is what we will be doing. Okay. So at December 31st, on December 31st, when I pay interest, my interest expense and the amount of cash I'm going to pay, I'm going to move this down here and write cash. The cash that I'm going to pay, the cash paid on this date is going to be the $600,000 times 6%. So it's going to be $600,000 times the 6% interest, which is $36,000. Now what I do is, this bond premium that I had over here, I need to amortize the bond premium. I need to amortize the bond premium over the life of the bonds. There are two methods, the straight line method and the effective interest rate method. I'm just going to go with the straight line method for the purposes of explaining it. And I'm going to tell you that my bond premium, I'm amortizing it. The bond premium is being amortized, which means it's being written off. The bond premium is being written off, and it is going to be written off over a 10-year period. So it's going to be $18,000 divided by 10 using the straight line method. So what happens to my interest expense over here? It's going to be the balancing figure in the journal entry. Again, let me change the color over here. So the interest expense is 34,200. So let me again quickly explain what has happened over here. The $18,000, which effectively is a gain, I'm not recognizing it as a gain, I'm calling it a bond premium. I'm going to spread that bond premium over the 10-year period. Each time by decreasing my expense, I'm increasing my net income. So what would have been a gain if I had taken it all in the first year and I increased my net income? I'm going to spread that over a 10-year period, 1,800 per year for the next 10 years. So the interest expense decreases. Bond payable is a long-term liability. It's due in 10 years. Bond premium is an adjunct account. So what does that mean? It basically tells you what its relationship is with bonds payable. It exists only in relationship with the bond payable, and we'll see how that is done in part B by way of a presentation. They tell you, suppose the remaining premium on bond payable is 10,800 on December 31st, 2025. How would it look on the balance sheet presentation? So let me do a quick balance sheet presentation for you. Obviously, we're just doing the partial balance sheet. So over here, I have bonds payable. The bonds payable number is not going to change. It's $600,000. Until the day I actually pay off that amount, that's still $600,000. What's different is the bond premium. The bond premium, they're telling me the remaining amount is 10,800. It was 18,000. They're telling me on this date it's 10,800. So that gives me bonds payable net number is 610,800. This is what's going to be presented in the balance sheet. So typically in a balance sheet, you will just see bonds payable, comma, net, and the amount will be given. These details are explained in the notes to the financial statement. The details that will be explained would be the term of the loan, what date it was issued, what the interest rate is. All of those details will be given in the notes to the financial statement. So for now, what we're concerned with is how we issue the bonds, when we issue the bonds, what our journal entries are, and how we recognize the excess amount that we have collected. Bond premium is an adjunct account. In the next example, we're going to look at bonds issued at a discount. So once again, my bonds sold at a premium, which means more than face value, because my bonds were desirable. Good financial conditions for my firm, and I'm offering an interest rate higher than the market interest rate. So that concludes this video on bonds payable issued at a premium. The next one we are going to look at bonds payable issued at a discount.